Welcome, everyone, and thanks for joining us today. During your working years, income is pretty straightforward. You get paid regularly, perhaps that's every 2 weeks, and then you plan your spending around that. Now, when you retire, instead of just one paycheck, income often comes from different places. Now, because of this change, it often leads to a very common question, which is, how do I pay myself now that I'm in retirement? So this session is all about helping you understand how retirement income works, how people usually structure it, to help you create an approach that works for you. Now, please keep in mind this session is general information only, so it's not personal financial advice. So before making a decision, please consider your own circumstances. If you have any questions along the way, please feel free to type it into the Q&A box. We have the education team in the background answering questions today. Now, many people wonder, where will their income come from once they stop working? Because while we're working, usually our income, it comes through regularly through our pay. But when you retire and you stop working, that pay also stops. So where will income come from then? Now, for most people, income in retirement usually come from four main places: your superannuation, savings that you have in the bank, investments outside of super, and possibly the government age pension. Now, these sources can provide you with money to live on in retirement, even though you're no longer earning a salary or a wage. Now, think of these as retirement income building blocks. So when you put them together, you can combine them in different ways to create the level of income that you want. Now, as you move from working life to retirement, your income, it doesn't stop, but where it comes from, it does start to change. So as you approach retirement, new income options, they gradually unlock over time. So we're going to have a look at, walk through what happens. Now, while you're working and under the age of 60, for most people, income is fairly straightforward at this stage. You're earning a salary, a wage. You might also receive income from your personal savings or investments. You can see there, super is locked. So it's growing in the background. It's growing through contributions. Now, at this stage, super is being saved or built for later. It's not designed to provide you with income, not just yet. Now, once you reach age 60, options start to open up. So while you're still working, if you're still working between age 60 and 64, you usually can't access your super straight away. However, you may be able to access some of it through a transition to retirement account. Now, a transition to retirement account, it's still super, but it's an account that lets you draw on income from it. People use a transition to retirement in different ways. Some use it to top up their pay if they reduce their work hours. Some use it to pay down debts before retirement, for example, a mortgage. Many people these days use a transition to retirement to grow their super balance while potentially save on tax. Now, if you permanently retire between age 60 and 64, or if you stop working for any employer after you turn 60, you've met what's called a condition of release. Now, what this means is your super, it unlocks, so you can access it directly if you choose to. Now, you may also decide to start a retirement income account. This is where your super would pay your regular income, usually tax-free, while the rest stays invested. And then from age 65, the rules, it becomes simpler. You can see there it stays unlocked, your super choice income account. This generally gives you more flexibility. So you're able to access your super while you're working, semi-retired, or even be fully retired. It doesn't matter. And then from age 67, some people may also become eligible for the government age pension, depending on their circumstances. We'll talk a bit more about age pension eligibility very shortly. So when you retire, you do have a few different options when it comes to accessing your super. Now, first of all, you can leave your super where it is, keep it invested if you want to. There's no rules that say you must start using your super. But when you're ready, you're able to withdraw it. You can withdraw lump sum as and when you need. You can also transfer it into an account-based pension. This is where you pay yourself a regular income. Now, keep in mind, you're not just limited to one option. You can actually take your super in a number of different ways. So just for example, you might take your super, some of it as a lump sum, and then the rest to provide you with an ongoing income. However, there will be different tax implications that you'll want to consider. Now, for many retirees, people choose to pay themselves regularly. So by opening up what's called that account-based pension, let's talk about how it actually works. So that account-based pension, it allows you to keep your money invested, earn returns while you receive a regular payment, much like a salary. So those payments, they are generally tax-free if you're over the age of 60. You can keep the rest invested, as I mentioned, so that they continue to work for you. In addition, any investment returns in your account, they are also tax-free. So this means more of the money that you earn, it stays yours, it stays in your account and remains invested. So how does it work? To open an account-based pension with Australian Super, which we call our choice income account, you would need to roll over at least $10,000. It can be from your Australian Super account or an account that you have with another super fund. Now, once that account is set up, you can choose how often you're paid. So you can choose from fortnightly payments, monthly, quarterly, twice a year, or yearly. Those payments are deposited directly into your bank account. Now, you can withdraw as much as you like. There is no maximum limit. So this means you can increase your payments anytime. On top of that, you can take out additional lump sums if and when you need them. The only requirement is that you meet the yearly minimum withdrawal amount, which we'll have a look at next. Now, it's also useful to know if your situation changes, you can move your money back into super. So for example, you might decide to return to work, and if you no longer need payments from your choice income account, you have the flexibility to transfer your funds back into your super account. Another thing to be aware of is there is a limit on how much super you can move into a retirement income account like choice income. Now, this limit is set by the government. It's called the transfer balance cap. It mainly affects people with larger super balances. So from 1 July 2025, the general transfer balance cap is $2 million. Once you've used up your transfer balance cap, you generally can't add more money later on, even if your balance goes down over time. Now, the thing to be aware of is your personal transfer balance cap, it may be different. So it depends on when you first started your retirement income account and also how much of the cap that you've already used. So it is a good idea to check your own details, and you can view your personal transfer balance cap in the ATO section through your MyGov account. Now, this slide, it shows a minimum amount that you are required to withdraw each year once you start a retirement income account. So the percentage, it's based on your age as at 1 July each year. When you're under the age of 65, the minimum drawdown rate is 4% of your account balance. And as you can see, it gradually increases as you get older. Now, you have the flexibility in terms of how you meet this requirement. So you can draw a regular income more or less frequently. You can withdraw just the minimum and always take out more if you need to. Now, if you do decide to open a choice income account, you may qualify for a tax saving known as a balance booster. If you meet the eligibility, we'll pass this tax saving on to you. Now, let me explain. Before retirement, super isn't completely tax-free. So Australian Super, we set money aside to pay for future capital gains tax. So when investment assets, they are sold. Now, when you move from a super or a transition to retirement account into choice income, it enters a tax-free environment. So assets sold in the retirement phase, they're not taxed. So that amount that was previously set aside, that's no longer needed. So that amount is passed to you as a balance booster payment, which is credited to your choice income account. Now, you may receive a balance booster if you move your existing Australian super or transition to retirement account to choice income. Also, you've held your super or transition to retirement account for at least a full calendar month, and you've invested in one or more eligible investment options. Like I said, if you're eligible, you'll automatically receive the balance booster. There's no need to apply for it. Now, to help us better understand income in retirement, let's have a look at a case study. So we have Judy. Judy is an example of an Australian super member. She spent her career working and now she's approaching retirement. Now, having reached this stage of retirement, Judy now faces some important decisions about next steps and what benefits she can expect. So let's have a look at her current situation. Judy is 65. She's single. She's also a homeowner. And actually, she just recently finished paying off her home loan. She's a teacher, currently earning $90,000 a year. She has about $350,000 in super and some surplus savings around $40,000 in her bank account. Now, after working out her retirement budget, Judy calculated that she'd like to have an income of around $50,000 a year in retirement. So we're going to have a look at what options are available when it comes to her super, and also what else she might be considering as she gets ready to move into retirement. Now, after some planning, she decides to make one last contribution to her super before she retires. Um, there's many different ways to add more contributions to super. For Judy's situation, she's decided to make a tax-deductible contribution. And the reason for this is because she has extra savings in her bank account. So she wants to make the most and also make the most out of her final year of work. Because by contributing, and for her situation, she's contributing $19,000 to her super as a tax-deductible contribution. This helps Judy achieve two things: boost her retirement savings before she retires, and also reduce the amount of tax that she pays. Because Judy is working and earning a salary, so she can claim that contribution as a tax deduction. So this will lower her taxable income and means she'll pay less tax overall. Now, as Judy moves closer to retirement, she does like the idea of having an income that feels familiar, so much like that regular pay she received while working. Now, to do this, Judy is going to open a choice income account, and she does that online via the Australian Super website. Now, with this, she has the flexibility to choose how often she gets paid. She can adjust her payments if her needs changes. She can take out lump sums when she needs more money, say for a holiday or for some home renovations. Now, remember, Judy, she needs to take out a minimum amount each year, but other than that, she has full control over her money. Another key benefit is that Judy's balance, it remains invested. So it means her income, it can last longer in retirement. But then it's important to remember though, investment returns, it can go up and also it can go down. Now, because Julie is over age 60, the income payments she receives, they are generally tax-free. And also the investment earnings in her account, they are also tax-free. So let's have a look at Judy's retirement outcome. So what does it all mean for Judy? Well, essentially, she's going to pay around $3,230 less in tax, thanks to that tax-deductible contribution that she made into her super account. She is also going to receive a balance booster payment of $2,600. Now, this was the average balance booster amount that was paid out to Australian super members in the last financial year. So that's why we've used this figure in this example. But as I mentioned earlier, there are a number of different factors that affect how much balance booster someone might receive. But in this example, we just use the average. Now, what this all means for Judy is that she's going to be able to meet her income needs of $50,000 a year up until the age of 84. Now, what we're going to do is we're going to fast forward a couple of years. So Judy, she's been retired for 2 years now. So she retired at 65. She's now 67, which means she can apply for the age pension. Currently, she has about $282,000 in her choice income account. So she's drawing a regular amount from that account to meet her income needs. What she's going to do next is to go through the process of applying for the government age pension. So let's talk about the age pension eligibility. Now, to get the age pension, you must have reached the age pension age, which is 67 or older. You also need to meet residency requirements. So you must be an Australian resident and also be in Australia the day you apply. In most cases, you need to have been an Australian resident for at least 10 years. Now, there are some exceptions. So if your situation is different, it is a good idea to check Services Australia's website for more information. Now, in addition, you'll need to pass what's known as the income test and also the assets test. Now, these will decide whether you qualify for age pension and also how much you might receive. If you find that you don't qualify when you first apply, you can always check back in because our income, our assets, it can change over time. Now let's have a look at how the age pension, how is it actually calculated? Because a really common question we hear from members is, how much age pension will I get? Now, at a very high level, as I mentioned, there are two tests. So there's that income test and there's also that assets test. Now, Centrelink, they will look at both, and whichever test gives the lower pension amount is the one they will use. The income test looks at money that's coming in. So employment income, if you're still working, there's also assessed income from savings, investments, and also super pensions. Now, this assessed income, it's often calculated using a set of rates. They're called or referred to as deeming rates. It's not based on what you actually withdraw. The assets test, it looks at things that you own. So your savings, super, investments, property other than your own home. And because the family home that you own, it's treated differently. Those asset thresholds, they do vary depending whether you are a homeowner or not. But the thing to keep in mind is you're not suddenly cut off if you go over those thresholds or limit, because both tests, they work on a sliding scale. What this means is the age pension, it reduces gradually as income or assets increase, because many people worry that if they earn a bit more or use a little bit more of super, it means that they'll lose the age pension. But in reality, that's not how it works, because the system, it's designed to taper. That's why concepts like deeming, work bonus, and other offsets, that they exist to help people, give people more flexibility, and also just avoid discouraging income or engagement in retirement. So we're going to have a look now through some commonly misunderstood parts of the age pension, like deeming and working in retirement. A question that often comes up from retirees is, if I take more money from super, will it reduce my age or even go on top of it altogether? Now, many people assume that every dollar they withdraw from super is going to be counted as extra income by Centrelink, but that's not how it works. This is where deeming is often misunderstood. Now, for most people with an account-based pension, Centrelink, they're not actually interested in how much you're withdrawing from super each year. Instead, they look at the total value of your savings, your investments, how much you have in your super balance. And then they use these deeming rates that you see here to estimate how much income those assets are assumed to earn. So if you're single, the first $64,200 of your financial assets, it's deemed to earn 1.25%. Anything more is deemed to earn 3.25%. If you are part of a couple and at least one of you receives a pension, the first $106,200 of your financial assets is deemed to earn 1.25. Anything more is deemed to earn 3.25%. Now, because of deeming, taking extra money out of super, whether it's for a holiday or for some home repairs, it doesn't automatically reduce your age pension, because it's not about how much you withdraw. Because of this misunderstanding, sometimes it could lead people to spend less in retirement than they actually need to. Now, another common question we often hear is, if I go back to work or decide to do some part-time work in retirement, will it affect my age pension? That concern is completely understandable, but this is also where the work bonus is often misunderstood. Now, the work bonus, it's designed to help people over pension age to keep working if they want to without being penalized straight away. So for example, in the future, Judy might decide to do some casual or some contract teaching work. Now, under the work bonus, the first $300 of gross fortnightly income, it doesn't count towards the age pension income test. So if you earn $300 or less a fortnight, Centrelink is going to treat that as zero income for pension purposes. Another helpful feature is that any unused work bonus, it can build up over time. So you can bank up those unused amounts, and you can bank it up to the maximum of $11,800. So this stored balance, it can be used to offset higher earnings in other fortnights, which is really handy if the type of work you do, it's seasonal or it varies from fortnight to fortnight. So going back to that worry, many people, retirees, worry that any work will mean a drop in pension. But for many, that's not the case. Thanks to the work bonus, doing some paid work doesn't automatically reduce your age pension. In fact, it can help increase your overall income while you stay active and also engage in retirement. Now, once people understand the work bonus, the next question that often comes up is, even if my age pension isn't going to be affected, won't I lose most of it to tax? Now, this is where the seniors and pensioners tax offset, or SAPDO, comes in. Now, SAPDO is designed to help people reduce the amount of tax they need to pay. So once you reach pension age, how it applies, it does depend on your total income and also your personal situation. But for many people, if they for many retirees, if they decide to do some small amount of part-time or casual work, SAPTO means you could potentially pay less tax than expected, or in some cases, pay no tax at all on that extra income. So many people assume I'll lose, if I work, I'll lose my age pension and get hit with tax. But the system that includes measures like that work bonus I talked about earlier, it helps with the pension side of things, and with SAPTO, it helps with the tax side. And together, this can make working in retirement more worthwhile. Now, like I said, how this SAPTO applies to your situation, it does depend on your total income and your circumstances. But what we want to call out is that it is an important piece of the puzzle that many people aren't aware of. So when we put everything together, some retirees find working a little bit in retirement can generally improve their take-home position, not just before tax, but also after tax as well. Now we're going to have a look at how Centrelink is going to assess Judy's situation. So on this table here, it shows what she owns, and whether Centrelink is going to count it under the assets test, income test, or whether they're exempt altogether. Now we're going to start with Judy's her home. Now, because her home is her main place of residence, it's not counted by Centrelink. And it's important because many people worry that their home is going to affect their age pension, when in most cases it doesn't. Now, next, let's have a look at lifestyle assets. So her car and also household contents. Now, these are going to count under the assets test only, and they are going to be assessed at their market value, not their insured value. Judy has that choice income account, which is her account-based pension. This is going to count under both the assets test and also the income test. Now, under the assets test, Centrelink is going to look at the balance of that account. Under the income test, Centrelink doesn't look at what Judy is withdrawing, as we spoke about earlier. Instead, they're going to apply deeming, which assumes the amount her account earns based on those set rates. And also with savings, Judy's savings account, so money that she holds in the bank, it's assessed under both the assets and also income test as well. So again, under the income test, it's subject to deeming, not the actual interest that her savings account is generating. Now, based on Judy's income and assets test, because they are under the current threshold, it works out that she is eligible for the government age pension. So from age 67, she will have two sources of income in retirement. So about $29,600 from the government age pension each year, and she's drawing around $20,300 from her choice income account. And together, these sources will provide Judy with that $50,000 a year to meet her income needs throughout retirement. And this just goes to show sometimes super and age pension, they can work together. And Judy's story highlights that often retirement income comes from more than one place. So if after today's session, it has raised some questions about your own situation, remember we do have tools, guidance, and also advice options available to help you explore more about what retirement income might look like for you. Now that concludes our How to Pay Yourself in Retirement session. We hope you found it helpful. You're now welcome to navigate back to the lobby when you're ready. Thanks again for joining us today.